If you have been studying smart money and ICT concepts, but still feel like the pieces do not fully connect, this video will bring clarity. We will show how inducement, liquidity, order blocks, and market structure operate inside one unified institutional framework. Welcome back to the ComLucro channel. In this session, you will understand how liquidity traps form before the real move, and how order blocks become the true execution zones once confirmation appears, helping you align your entries with professional market behavior. If you enjoy this kind of content, make sure to like the video, subscribe, and turn on notifications so you do not miss what comes next. And let us know in the comments what topics you want us to cover next. You will also find links to our trusted partners in the description. When you use those links, you help support the channel and keep this content moving forward. Traders, do you know what inducement really is? Inducements are specific market setups designed to tempt traders into entering positions, often in the wrong direction, so smart money can collect liquidity. In simple words, an inducement is a trap for traders that makes them enter the wrong direction before the real move starts. Because smart money needs liquidity, they induce traders into early breakouts, fake reversals, or fake pullbacks, order blocks that look clean but are not the real ones, FVG fills that look like entries, equal highs or lows that look tradable, and etc. Then price reverses, sweeps their stops, and moves in the intended direction. If you ask why understanding inducement concepts is important, it is because this understanding helps you avoid entering too early at fake levels or liquidity traps, and instead wait for the real point of interest. This dramatically improves the win rate. But to apply this properly, you need to understand how inducement actually forms in real market conditions. Liquidity-based inducement is the most common form of inducement you will see in the market. This is when price intentionally creates a new high, a new low, or a small order block or breaker that looks too clean, with the sole purpose of trapping traders, collecting their liquidity, and then delivering the real move. And this happens every single day, on every market, and on every time frame. The main objective behind this behavior is to generate stop losses that smart money can use as fuel. By pulling retail traders into the wrong side of the market, their stops can be collected right before the true move begins. That is why you constantly see a tiny high before price drops, a tiny low before price rallies, a fake breakout before a reversal, or equal highs and lows getting swept by 1 or 2 pips. These are not coincidences. This is smart money deliberately engineering liquidity. With that in mind, let's go deeper and look at real price chart scenarios. Here we have a trading setup where price taps into a very strong daily demand zone and reverses, forming a valid change of character. Naturally, we expect price to pull back into the bullish fair value gap, sitting in the discount area, which is where we want to look for buys. However, before price fully taps into the 1-hour fair value gap, something important happens. Price pushes lower, reacts briefly near the fair value gap, and then immediately reverses, forming a new lower low. This new micro low is pure inducement, and this is exactly where many traders get trapped. That minor low convinces premature buyers that price has already mitigated the 1-hour fair value gap, and that the reversal is already underway. Because of fear of missing the move, they enter too early and place their stop loss right below that micro low, creating a clean pool of sell-side liquidity. This is precisely what smart money is looking for. Smart money uses this inducement to trigger early buyers, build liquidity below price, make the market appear weak, and trap retail traders who place sell stops under the micro low. All of those stops become the liquidity institutions need to fuel the real bullish move. Once enough liquidity is available, price dips slightly lower, sweeps the inducement low, collects those stops, and finally mitigates the true fair value gap. the one institutions were targeting from the very beginning. At this stage, liquidity has been collected. The imbalance is filled, and the true institutional point of interest inside the fair value gap has now been mitigated. However, inducement does not always appear as clean or as simple as the previous scenario. In some cases, instead of forming a small micro low, price creates a fake change of character on its way down and builds equal lows just above a tiny, very clean order block. At this point, three components are working together. A fake bullish CHOCH, equal lows which build a strong liquidity pool filled with retail stop losses, and a fresh, very small order block that formed inside the CHOCH leg. This tiny order block is not a real point of interest. It exists purely as an inducement. Its only purpose is to lure traders in early and attract even more premature sellers before price reaches the major true point of interest below. Smart money uses this small order block to generate additional stop losses beneath it, increase available liquidity to fuel the real move, and encourage retail traders to enter early based on a false signal. Now, you might wonder why price needs to form an inducement right before tapping into the fair value gap. The reason is simple. If price moves directly into an FVG with no inducement, there is no liquidity. Smart money has no fuel to reverse the market. The reaction out of the FVG becomes weak, and the entire setup can fail due to a lack of sellers to buy from. In simple terms, inducement is what creates the liquidity that fuels the move out of the fair value gap. So if inducement builds the liquidity before the move, the next question is simple. Where do institutions actually enter? Now, let's begin with the basics. What exactly is an order block? Order blocks are essentially refined or optimized supply and demand areas. From basic price action theory, we know that the market always moves in a rhythm of impulsive and corrective waves, shaped by the collective behavior of market participants. We identify the starting point of an impulse as a demand zone. This happens because in that area, traders have previously entered long positions with a clear intention. When price returns to the same demand zone, there is a higher probability that those traders, or new ones recognizing the opportunity, will start buying again. Simply put, demand zones highlight areas where we expect buyers to step back into the market. Likewise, the beginning of a downward move is identified as a supply zone, where traders have previously taken short positions. When price revisits this zone, it often leads to renewed selling pressure. In other words, supply zones are areas where we expect sellers to become active once again. Now, order blocks are a special type of supply and demand zone, but they form when a large number of buyers or sellers enter the market at once, creating a visible imbalance in price. This imbalance between buying and selling pressure can often be identified through what we call fair value gaps. These gaps appear when price moves too quickly in one direction, leaving certain orders unfilled, and the market may later return to those areas to restore balance. We usually mark the candle that appears right before the gap as our order block zone, because that is where major trading decisions were likely made. When price comes back to this order block, we often see a strong reaction as institutional buyers or sellers re-enter the market. So in essence, order blocks are still supply and demand zones, but the key difference is that we focus specifically on areas where larger institutional orders were placed, revealing where the real smart money operates within the market. But identifying the zone is only part of the process. The real edge comes from how you execute around it. This strategy operates using 2 time frames, and we've simplified it into 5 clear steps. First, analyze the market structure on the higher time frame to determine the overall direction. Second, mark the key order blocks. Third, wait for price to pull back toward those zones. Fourth, look for a change of character on the lower time frame to confirm the reversal. And finally, execute your entry from the order blocks on that lower time frame. As mentioned earlier, this setup always relies on two different time frames. The higher one serves as your main chart for day trading analysis, and the lower one is used for confirmation, precise entries, and managing your active trades. It doesn't matter exactly which time frames you prefer to use. The important rule is that your entry time frame should be at least 2 times lower than your higher time frame. For example, many traders combine the 1-hour chart with the 15-minute chart, or the 4-hour with the 1-hour, depending on their trading style. The next important point is that this strategy can be applied to any market or asset class. It makes no difference whether you trade Forex, crypto, indices, or stocks, because price action principles remain consistent across all charts. Still, make sure to backtest thoroughly before trading with real money, so you can see how the strategy behaves under different market conditions. Now let's return to analyzing the market structure, which is the foundation of this plan. The very first step is to identify the market direction. Trading in alignment with the main trend almost always gives you a higher probability of success. To determine that direction, look for clear breaks of structure, changes of character, and recognizable reversal patterns on your chart. If you can't clearly see the direction on a specific time frame, it's better to skip that setup entirely. Trading when the market direction is uncertain only increases your risk. It's much safer and more effective to focus on instruments or pairs that show a clean, obvious trend. This allows for better decision-making and more consistent risk management. Next, we identify the fair value gaps and mark the order blocks, which serve as our main trading zones. At this stage, we can simply place a sell limit order at the order block and position our stop loss just above it. However, for a more conservative approach, it's often better to zoom into lower time frames once price reaches this area. That way, we can observe how the market reacts around the zone and confirm whether the trade setup is truly valid. We want to see a clear rejection from the order block to ensure that it is being respected. Even though this setup has a high probability, price does not always reverse perfectly from the box. The market can easily ignore an order block, so patience and confirmation are key. The next step is to wait for price to pull back into the order block zone, and then drop down to a lower time frame for closer analysis. Remember, never jump into the market before price actually reaches your zone. Many traders get trapped by entering too early, right before the market delivers the real move. Up to this point, everything we have discussed is what separates a real institutional setup from an inducement trap. Most traders lose money because they mark a zone and enter immediately. But institutions do not operate that way. They allow liquidity to build. They allow early participants to commit. And only after the market reveals a genuine shift in short-term structure do they execute. That is why confirmation is not optional. It is the filter that protects you from trading the inducement instead of the real move. Now, in the final step of this trading plan, we look for confirmation signals and execute the trade on the lower time frame. After price enters our zone, we need evidence that the short-term uptrend has ended and that the market is preparing to move lower. To identify this reversal, we look for a change of character. This occurs when price breaks below a recent swing low, confirming that the short-term uptrend is over and that momentum is now shifting downward, in alignment with the bearish direction from the higher time frame. Once this reversal is confirmed, we wait for the market to form new bearish order blocks on the lower time frame, and then take the trade. This is why the method is known as order block within order block. It's important to note that the lower time frame order block does not always need to be fully contained inside the higher time frame order block zone. After identifying the lower time frame order block, We place a sell limit at the start of that zone and set our stop loss just above it for protection. For trade management, we aim for multiple targets. The first target is usually a 1-to-2 risk-to-reward ratio. Once price reaches this level, we close half of the position and move the stop loss to break even. The next target is typically the first significant support or liquidity zone ahead of price on the higher time frame chart. Here's a quick recap for the bullish scenario. The same rules apply, but in reverse. We wait for price to reach our higher time frame order block. Then, we look for a change of character on the lower time frame, which occurs when price breaks above a swing high. This confirms that the short-term downtrend has ended and that buyers are now taking control of the market. Once this is confirmed, we look for new bullish order blocks forming on the lower time frame and place a buy limit order at the beginning of the zone, with the stop loss positioned just below it. Targets are managed in the exact same way as in the bearish setup, following a structured risk-to-reward approach. Everything we have discussed so far only becomes powerful when you see it unfold in real time. This is where many traders fail. They understand inducement, they understand order blocks, but they do not wait for structure to confirm the shift. So instead of aligning with institutional positioning, they become part of the liquidity that fuels it. Let's now see how this framework actually plays out on a live chart. Here we have the euro-dollar on the 1-hour chart. The recent price action shows that the market had been in a clear long-term downtrend until it suddenly shifted direction by breaking above this protected low. That break of structure represents a change of character, signaling that demand has taken control and that a potential bullish reversal, or the beginning of a new uptrend, may be underway. Since the higher time frame direction is now bullish, we're only interested in looking for buying opportunities. The next step is simple. Identify the fair value gaps and mark the order blocks. In this example, we can see two distinct fair value gaps, so we mark the candles that created those gaps as our order block zones. These areas become our key trading zones for potential entries. If the price pulls back into any of these zones, we'll then zoom into the lower time frames to look for confirmation signals before taking a trade. So let's see how this plays out. The price has just tapped into the first order block, so we switch to the 5-minute chart to search for an entry. On this lower time frame, we want to see clear signs of reversal, confirmation that the order block is being respected, before opening a long position. For confirmation, we look for a change of character on this lower time frame. This happens when price breaks above the swing highs that led to the previous downward move. Let's play the price forward. Here, we can see that price actually broke below the order block without showing a clear change of character. Although there was a brief reaction to the zone, it failed to confirm the reversal we were looking for, meaning there's no valid trade setup at this point. Now let's go back to the 1-hour chart. On this chart, we still have another unmitigated order block zone below. If the price moves down into this area, we'll once again switch to the lower time frame to look for a precise entry signal. Let's see how the price develops next. The price has now tapped into this order block, so we zoom into the 5-minute chart again. On the 5-minute chart, the market has already shown a clear change of character. Exactly the reversal signal we were waiting for. This tells us the short-term downtrend has ended, and we can now start looking for long setups with confidence. The next step is to wait for price to form bullish order blocks, and then use them as entry points. Here, the market creates its first bullish order block, so we open a long position. As price continues to push higher, another order block forms, but this time without invalidating the previous setup. We open a second long trade based on this new formation. This approach is important because the pullback to the very first order block doesn't always happen. Sometimes the market only returns to the second one before continuing higher. In the worst case scenario, the price could drop deeper and hit both stop losses. And that's why we always trade with reduced risk. Now, let's see what happens next. The price hits the stop loss of the second trade, but keeps moving higher, triggering the first one. A bit later, another order block appears. Once again, without closing the first trade, we take a new long position at this fresh order block zone. We continue repeating this process until the market reaches our target. In this example, the previous high on the higher time frame. Inducement builds the liquidity. Order blocks define the real institutional zone. Confirmation separates the trap from the true move. When you understand how these pieces work together, the market stops feeling random and starts revealing structure. Study it, backtest it, execute it with discipline, and I will see you in the next lesson. Please also remember that the mission of the ComLucro channel is simple. We focus on giving traders clarity, confidence, and structure, so market decisions are made with discipline and intention. On this channel, you will find complete courses built as a true trading masterclass. We teach market structure, higher time frame trading, and supply and demand, always focused on understanding price behavior and executing with a professional mindset. We also go deep into trading psychology, risk management, and consistency, because trading is not just about charts. It is about mindset, discipline, and structured execution over time. There are no shortcuts. Real progress comes from continuous learning and practice. Our main courses include Smart Money Concepts, Technical Analysis for Day Traders, Trading Psychology, and the Wyckoff Method course. Alongside our courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, and Larry Williams, whose experience has shaped how traders understand markets today. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are on the same journey. Make sure to subscribe and turn on notifications so you don't miss our latest lessons and insights. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? What topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro Trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.